You do what you were told to do. Every month, a portion of your paycheck goes straight into your savings account. You don't touch it. You feel responsible. You feel smart. You feel like you're winning. You're not. In fact, the money sitting quietly in your savings account is shrinking right now, today, this very moment, and almost no one explains why. Not your parents, not your school, not the bank that's happily holding your cash. For most of human history, holding on to what you had was survival. Store grain. Keep firewood. Pour dried meat. The logic was simple. More stored meant more safe. Your brain still runs that ancient code. But the world it was built for no longer exists. And that mismatch is costing you a future. Let's start with a number, 3.4. That's the average annual inflation rate across developed economies over the last 2 decades, according to data tracked by the International Monetary Fund. Inflation, in plain terms, is the rate at which the purchasing power of your money quietly disappears. If something costs $100 today, in 1 year it will cost roughly $103.40. In 10 years, that same thing could cost $140 or more. Now here's the question your bank doesn't want you to ask. What interest rate is your savings account actually paying you? In most standard savings accounts across the United States, Europe, and Southeast Asia, the answer sits somewhere between 0.01% and 0.5% per year. Some high-yield savings accounts offer slightly more, around 4 to 5% during periods of high central bank rates. But the average person isn't using those. The average person has their money sitting in a basic account earning almost nothing. Run the numbers. If inflation is 3.4% per year and your savings account pays you 0.5%, your money is losing purchasing power at a rate of roughly 2.9% per year. Every single year, silently, without anyone telling you. This is not a small leak. Robert Kiyosaki, the author of Rich Dad, Poor Dad, called your home a liability rather than an asset, and the financial world nearly collapsed into outrage. But the math behind what he was pointing at was real. The things most people call safe, savings accounts, low-interest bonds, even their own house in certain markets, can quietly destroy wealth over time when inflation is factored in. Let's make this concrete. Imagine you save $500 a month starting at age 25. By the time you're 65, you've put away $240,000 of your own money. In a standard savings account earning 0.5% annually, you'd end up with approximately $249,000. It sounds like you gained $9,000. But after adjusting for 3% average inflation over those 40 years, the real purchasing power of that $249,000 is closer to $76,000 in today's money. You didn't grow your wealth. You cut it by 2/3. Now imagine a different version. Same $500 a month, same 40 years. But instead of a savings account, you invest in a simple low-cost index fund tracking the S&P 500, which has returned an average of approximately 10% per year before inflation since 1957, as documented by financial economist Jeremy Siegel in his landmark research on long-run asset returns. After 40 years, that same $500 a month grows to roughly $2.65 million. Even after adjusting for inflation, you've built something real. The difference between those two futures is not income, is not luck. It is one decision about where your money lives. But why don't people make that decision? Why does almost everyone default to saving when investing is so clearly more powerful over time? The answer lives inside your nervous system. Behavioral economist Daniel Kahneman, who won the Nobel Prize in economics in 2002, spent decades studying how humans actually make financial decisions. His research revealed a phenomenon called loss aversion. The finding that the psychological pain of losing $100 is approximately twice as powerful as the pleasure of gaining $100. Your brain is hardwired to protect what you have rather than risk it for more. Savings accounts feel safe because you can always see exactly what's there. The number never goes down. That certainty triggers a deep neurological reward. Investing, by contrast, means watching that number fluctuate. Markets drop, portfolios dip, and your ancient brain reads that fluctuation as danger as a predator in the grass, as a reason to pull back and protect. So you save, and you call it discipline, and the years pass. The economy also has a structural interest in keeping you there. Banks collect your deposits and lend them out at 7, 8, 10% interest. They're not offering you 0.5% because that's all your money is worth. They're offering you 0.5% because that's the minimum required to keep you from looking elsewhere. The spread between what they pay you and what they charge borrowers is one of the most profitable mechanisms in modern finance. Your savings account is not a safe. It is an unpaid loan you are giving to the bank. Now let's reconstruct a scene. You are 32 years old. You have $15,000 saved. You feel proud of that number. It took years. But this morning, before you open this video, that money was already $42 smaller in real terms than it was on January 1st. By the end of this year, inflation will have quietly erased roughly $510 of purchasing power from it. In 5 years, assuming average inflation, the real value of that $15,000 will be closer to $12,700. You haven't spent a cent. You haven't made a single bad decision. And yet your wealth is contracting. This is not a crisis. It is a direction. And a direction can be changed. The counterintuitive truth that most financial systems never teach you is this: the safest thing you can do with money is put it to work. Not in speculation, not in lottery tickets or high-risk crypto bets. In boring, simple, long-term vehicles, index funds, diversified equities, real assets that compound over time at a rate that outpaces inflation. Warren Buffett, the most successful long-term investor in recorded history, has said repeatedly that his wealth was not the product of genius. It was the product of starting early and letting time work. The engine is compound interest. Albert Einstein, according to widely cited accounts, reportedly called compound interest the eighth wonder of the world. Whether or not he actually said those words, the math behind the idea is irrefutable. Money earning returns on its previous returns, year after year, creates curves that feel impossible until you see them. A $10,000 investment at 10% per year doesn't just earn $1,000 in year 1. In year 2, it earns $1,100. In year 10, it's earning $2,358. In year 30, the original $10,000 has become $174,000 without a single additional dollar added. Saving that same $10,000 in a 0.5% account for 30 years gives you $11,614. The difference is $162,000, created by the same starting amount, separated only by where the money lived. The lesson is not to spend everything and save nothing. An emergency fund, 3 to 6 months of living expenses held in accessible cash, is genuinely important and genuinely protective. That cash is not an investment. It is a buffer. It is the financial equivalent of keeping firewood stacked by the door so you don't freeze before spring. That part of the old instinct is still correct. But every dollar beyond that emergency buffer that sits in a low-interest savings account is a dollar that is slowly, silently being consumed by the invisible tax of inflation. Not because you are careless, because no one ever told you what money actually does when it's left alone in the dark. Your money is either working or it is shrinking. There is no third option. The illusion of safety is the most expensive belief most people ever hold. You do what you were told to do. You save. You feel responsible. You feel safe. Now you know that feeling and that reality are two very different things, and that the gap between them is where most people quietly lose the financial future they spent a lifetime building.